Hello and welcome to the paid weekly recap for the week ending July 11th, 2025. I'm Keith Harwood, CIO of Yellow Tunnel, and also pictured as Vlad Karpel, the CEO and founder of Yellow Tunnel and the creator of the artificial intelligence behind the predictive AI for dynamic market system. Before we get started in our normal disclosures, options involve substantial risk and are not suitable for all investors. Yellow Tunnel and myself are not investment advisors and not registered with the SEC nor FINRA. The information in this presentation is for education and information purposes only and should not be considered trade advice. Finally, myself and/or the team at Yellow Tunnel may have a financial interest in the securities presented and the trade ideas. If you need more time with the disclosures, please go ahead and pause the video now. Otherwise, we'll get into the market recap for this week. So overall, we had the market conditions in the 10-year yield fairly neutral. Coming into the week, we were sitting around 435, ended the week around 442, slightly higher. We had some tariff news this week, implementations going in August 1st on various countries. Broadly speaking, it had minimal impact on the overall 10-year yield after bottoming out around 4.2. We've topped out below 4.5. We're very range bound. Expectations are for rate cuts this year, just more than likely not going to be this month anymore. The Fed wants to see what happens with these tariffs before getting aggressive with interest rate changes. And so, frankly, I don't expect to see anything at the July meeting. However, that may change in the coming weeks. We do have earnings starting up this season starting up this week with financials. And broadly speaking, the market is holding up fairly well heading into that earnings season. The S&P 500 did make a new high on Thursday, handled the tariff updates resiliently, held above the 10-day moving average, held above the February 19th high. Everything is still pointing in the direction of the bull with a normal procedure of a minor dip and consolidation this week that helped bring the RSI back below 70. That overbought RSI heading into the end of last week did raise a little bit of concern, but overall we handled it well. We've pulled it back down. It's still somewhat elevated here, and a bullish start to earnings will likely push that back up above 70. But overall, there's not much for the bear to attach to right now, given that even tariff news wasn't able to give the market any sort of dip. It seems that they're going to need some bearish earnings inputs to start to get back some semblance of control. Tech on the whole made their new high on Wednesday, pulled back a little bit Thursday, Friday. There's been some market rotation and very similarly holding above the 10-day moving average, holding above the February 19th high. Everything is still pointing in the direction of the bull on the whole, albeit on a grinding higher expectation at this point. Finally, small caps started to look to gain some leadership this week. Had a very nice run Tuesday, Wednesday, Thursday before a reasonably large dip on Friday. So small caps trying to get caught up to the rest of the market, still below the January, February highs. Not a new high for the year yet. Financials are a big part of this. Healthcare is a big part of this. Healthcare has been a laggard. Financials started to get a little bit of a dip this week heading into earnings, maybe a little bit of risk off in preparation for those earnings, a little bit of profit taking just in case. And that has held small caps back from making those new highs. We've gotten close. 230 is the target. 4% away at this point. We'll see if that can come through with maybe some good earnings this week. But overall, small caps continue to be the dog of this market with a heavy focus on growth, e-tech, and just broad market behavior. The VIX continues to hang near lows here around 16%, just above on the close on Friday. This is very low relative to what we were seeing when tariffs were a major concern with China in April. However, it is not low on the long-term horizon. There still appears to be some hedging activity from this marketplace, buying put debit spreads. We see it a bit in the skew. It looks more than anything to me that people are rolling up the hedge for the long portfolio. So maintaining the long, but having defined risk to the downside, which seems like a naturally smart, intelligent decision. But that said, the VIX may deserve to be lower given that we're at all-time highs. So with the location of the market, this VIX appears like it could start to come down, but maybe the earnings input is what is necessary in order for that to achieve such a pullback. All right, so maybe down to 14, 13%, limited to the downside. Overall, options premium is cheap, but not super cheap. does still provide some opportunity for the long option player as well as for those looking to hedge a bullish portfolio. If the bear is going to have any chance here, that will come with a big spike. But right now, I don't see that input that's creating that major risk off behavior. And again, I think earnings may be the key there. Now we had two positions that were held over the weekend. One was NASDAQ. Monday was a good day to exit. So Tuesday had a big pullback, so I'm glad that we were out on Monday. We did retest and make a new high on Thursday, but exiting on Monday seemed to be the dead-on right timing. Stock up about 1% for the 6-day period, but it generated an 11% profit in the options. So having that benefit of a general bull market here in the NASDAQ stock and the low implied volatility allowed for some nice returns here on the whole. Secondarily, we had the SBUX trade, and we actually pulled back a little bit on Monday before resuming some of the uptrend Tuesday, Wednesday. But this 200-day moving average is providing some overhead resistance in SBUX. The attempt to break out on Wednesday was faded. Again, glad to be out of this trade and for a nice win. The 3% gain in the stock led to a 14%, almost 15% profit in the options on the second half after a 23.5% profit on the first half of the trade for the exit on Thursday, sorry. So overall, very nice positive trade, average return of just under 20% for the entire position. And that's great for compounding some returns and getting some nice cushion here on profits. On top of that, we had 3 new trades this week. EMR was our first one, Emerson Electric. From the Tuesday open through the end of the week, we did have some lightly bullish activity with, again, an attempt to really push out on Thursday and break out, but that got faded back down to a 140 board in the market. So we looked to exit half that position on that 1% rally over the 3 days, 13.5% profit in the 3 days for the options. So again, that leverage of the options really paying off nicely. And if we do see a retest of those highs on Monday, we could have be in for a very significant profit. But for now, again, 13.5%, nothing to be too disappointed with for a 3-day holding period. Morgan Stanley was the loser of the week. So out of the 5 trades total, 2 held over the weekend and the 3 new trades, Morgan Stanley was the disappointment as financials broadly seem to be getting some profit taking this week heading into earnings. Now, Morgan Stanley opened near the highs of the session on Tuesday, closing lower. And while it tried to fight back, it just couldn't get back to that break-even point. So we did see about a 1% drop in the stock with about a 28% loss in the options. Earnings this week may trigger a lot more bullish flow for Morgan Stanley, and it may trigger some further selling pressure. That will be to be determined. But overall, exiting the whole position there and just taking that loss and focusing on these winning trades is a much better avenue historically for the performances we've seen. And speaking of those winning trades, we had Nucor Steel. One of the benefactors of some of this tariff news opened up below the previous highs here on Tuesday and started to push through with a nice breakout on Thursday and then a little profit taking on Friday. Near the highs, we were getting close to a point where we were going to exit half the position as we approached 100% return. Didn't quite get there. I think we capped out around 70%. So again, exiting half the position, still showing some bullish signs here. So looking to potentially generate some further returns on Monday. 3% run for the stock and a 36% profit for the options. So a nice performance out of NUE. That was the biggest impact on our P&L for the week for the system. Maintaining half positions in EMR and NUE over the weekend and looking for profit taking in those on Monday before looking at 2 new trades this week. So overall, a great week for paid. Looking for another great week coming ahead. And of course, if you are looking for some more ideas and some more thoughts, make sure you're joining us in the live trading room. At the open from 9:15 till 10:15, 10:30 Eastern, and at the close from 3 to 4 Eastern. Vlad and I are present, and we're talking live with all of you about what's going on in the market, opportunities that are there for other types of trades generated by the AI signals, technical signals, and options market opportunity, as well as getting more excited, I think, about some of these earnings opportunities that are coming into play again this week. So be sure to join us. The results speak for themselves. We're always happy to answer any questions. And if you do need to reach out to us outside of that, you can always email us. I'm Keith@yellowtunnel.com and Vlad is Vlad@yellowtunnel.com. Thanks again, everybody. I'm looking forward to another great week.